Business owners, this video is going to be big for you. If you're putting your own money into the business, you are not increasing your income. It should not hit your profit and loss statement. What you're doing is you're adding owner's investment into the business. So it should only touch your balance sheet. It's an equity transaction, not an income one. This is very important because I get this question all the time. Whenever a business owner is, funding their business, especially at the beginning, they're wanting to know how that transaction should be handled. And a lot of them will just see that, it's a deposit into their bank account, just like all the other income that's coming in from their business, it's a deposit. So it should be handled the same, right? No, it should not. It should be handled differently, because if you handle it as income, then you're just going to be taxed on that whenever you should not be taxed on it at all. It's not something that increases your business's revenue or profit. It's something that you are investing into the business. So the business owes that money back to you. And that should never be taxed. This is a big thing for a lot of business owners. They try to, replicate that and put that into the profit and loss. And it really does hurt them in the end, because that's inflating your income more than it should be. This should only increase on your balance sheet. So on the bottom of your balance sheet in the equity spot, it should have owner's investment. And that's where this should increase. It should be coming from whatever bank account, your personal bank account or something, into the business bank account and going and categorized as an owner's investment. And same goes with the opposite way. Whenever you're pulling money out of the business into your personal bank account, it's not an expense. And a lot of people mess that up too, because again, your bank account's reducing just like all the other expenses that you've incurred. But what's happening is you yourself are pulling that money out and putting it into your business or into your personal bank account. And that is going to be considered owner's draw. So what you're doing is you're essentially paying yourself back the money that the business owes you. And this is going to reduce the equity that you have in the business. So reduce the amount of money that the business owes you. So we're reducing that amount by pulling money out and putting it into our personal account. This is very important to understand, because if you categorize that as an expense and you take the write-off that year, you're inflating your expenses and you're taking more write-offs than you actually should, and you will get in trouble if the IRS ever does audit you. Penalties will happen, and I'm sure other things could happen as well if the number's big enough. So make sure that you're understanding the difference between income and expenses and owner's investment and owner's draw, because the income and expenses should stay on your profit and loss sheet. The owner's investment and owner's draw stays on your balance sheet. And those two things are really big differences and will either increase or decrease the amount of taxes that you owe, whenever it should be only based on your income or the expenses that you have for your business, not what you've put in or what you have taken out in order to pay yourself or in order to fund the business. And this is something that I really want to harp on. That way, you don't do this and come tax time, you're like, well, I've made so much money, I don't understand, I haven't really made any sales or anything. And it's like, well, it's probably because you've put your own money in there. So the next time you are moving money between your business and your personal account, just remember that is not a P&L or profit and loss sheet play. That's a balance sheet play, because it's an equity play. If you need help with this, follow the channel. I come out with tips like this all the time, and thanks for watching.